Good morning and good afternoon, depending on where you're joining us from. My name is Andreas Stepnitzka. I'm Deputy Director at EFAMA, where I lead our advocacy work on pensions. I'm pleased to welcome you to EFAMA's second webinar in our pension series. Today, we're focusing specifically on the US retirement system, and for that, we're partnering with the Securities Industry and Financial Markets Association, or SIFMA for short, which represents the US securities industry. In our first webinar in November, we took an in-depth look together with academics from McGill University as how pay-as-you-go pension systems compare to partially capitalized ones. A common piece, let's say, of feedback was the interest in exploring insights from the US. So today's session is a response to that request. I think it's particularly timely given that the EU has recently proposed measures to bolster its supplementary pensions market. Of course, the US and the EU have very different views on the role of the state in securing citizens' retirement income. While state-sponsored Pillar 1 pensions are fundamental to the EU's welfare system, the US relies very much less on such arrangements. That said, I want to be clear. Today's discussion isn't about suggesting that the EU should reduce its efforts to modernize Pillar 1. Far from it. We recognize that demographic changes are creating a pension time bomb in Europe, and it's crucial that we all find ways to ensure that everyone can retire comfortably, whether through state, occupational, or private pensions. From that perspective, we'll take a more close look at key elements of the European Commission Supplementary Pensions Package and see how these compare to the US experience, which has simply a much longer history in supplementary pensions. The goal is to understand what is working and what isn't. So in other words, what challenges remain. To do this, and with the help of SIFMA, we've invited a number of experts on the US retirement system who will try to answer all of my, and hopefully by extension, your burning questions on US pensions. So please let me introduce you to the panelists in no particular order. First, we have Lisa Bleier. She's Head of Wealth Management, Retirement and State Government Relations, working at SIFMA for the past 15 years. Then we have Lisa Hunt, Executive Vice President of International Services at Charles Schwab, one of the US's, I think, most prominent investment advisors and broker-dealers. Then we have Sudipto Banerjee, who's Global Retirement Strategist at Rowe Price. He has a strong background in economics and pensions, and I think has been with Rowe Price now for over 8 years. Last but not least, we have Andy Budden. He's the Head of Retirement Solutions for Asia and Europe and represents Capital Group, which is one of the oldest and largest asset managers in the US. So thank you, Lisa B, Lisa H, Sudipto, and Andy for taking the time to talk pensions with me today. Before we dive into the discussions, I'd like to remind our listeners that you can ask questions throughout the webinar by using the QA function. I will try and do my best to monitor the chat and either incorporate your questions directly into our ongoing discussions, or we'll simply take a few minutes at the end of our webinar to answer them. Now, with that covered, Lisa B, maybe I can start with a simple icebreaker question, and I promise it's going to be an easy one for you. I know SIFMA is well known in the US, but could you briefly introduce your association to our European audience?
Absolutely. Thank you, Andreas. On behalf of the Asset Management Group of the Securities Industry and Financial Markets Association, or as we refer to ourselves as SIFMA AMG, it is great to co-host today's discussion alongside our partners at EFAMA. For those who are less familiar with SIFMA AMG, we represent the asset management community, providing views on US and global policy and creating industry best practices. Our members manage trillions of dollars on behalf of retirement savers, pensions, and long-term investments. A core focus of our work is helping ensure markets and policy frameworks support stronger retirement outcomes. And it's worth noting, T. Rowe, Schwab, and Capital Group are all SIFMA AMG members. Retirement security is a shared global challenge. As European policymakers consider reforms to address growing pension pressures, we've been working closely with European policymakers and our colleagues at EFAMA to exchange the lessons learned, share the US experience, and collaborate on practical solutions that expand access to long-term investing. We're glad to bring this transatlantic conversation together today, and we look forward to today's discussion.
Thank you very much, Lisa. Makes our work, I think, and our discussions sound very important. So I think, and that's very good. Look, maybe another one of those kind of icebreaker questions, but still, I think important enough, given all the extensive U.S. retirement background that you have. Could you maybe briefly just set the scene, describe how the U.S. retirement ecosystem works, and we can take it, I think, from there.
So I'm going to do fairly brief. It's very hard to bring all of the U.S. system down to a brief few remarks, but I'm just going to give a little history, rolling back the clock just a little. So in the 1970s, the U.S. had about 30 million people covered by defined benefit retirement plans, where the employer contributed all the funds and individuals were not responsible for their own savings. But things had started to change so that by 2000, the majority of workers were actually covered by 401k plans instead of defined benefit plans. So the difference was individuals became more responsible for their investments. The system evolved this way for a few reasons, but a big one is that individuals were more likely to move from one job to another. So the defined benefit pension plan did not have a strong appeal to as many employees. And because of the way the system worked, individuals were rewarded with greater payouts the longer they stayed. So if they moved from job to job, they never got the benefit of the greater payouts. As a result, employers who saw the defined benefit plan system as very costly realized that employees were not recognizing the benefits and expenses of that system. And since the retirement system in the US is purely voluntary, employers were only providing this benefit because they were choosing to do so. And if the employees were not going to recognize the benefit, they knew they needed to evolve. And around then is when we came out with the 401k system. And as a result, the 401k system has grown exponentially. So I look forward to our deep dive into that.
Perfect. Thank you very much, Lisa. That overview, I think, sets the scene quite nicely. Lisa, maybe if we also want to bring in second Lisa. Lisa Bleier was talking very much also about individuals here. When I was preparing for our discussion today, I actually came across an interesting opinion piece that I think you wrote in Forbes about investment culture in the US not too long ago. Maybe to paraphrase, I think you were kind of suggesting that other countries, you were talking, I think, about the UK at the time, but could also build this, let me quote, this nation of investors. Looking at numbers, I think it's pretty clear that there is a huge difference between the US and the EU. In the US, I looked it up, 62% of Americans own stocks, either directly, indirectly. Half of the private sector employees or workers have 401ks. Just maybe not using exactly the right figures, but if you look at Europe, European households hold over 41% of their wealth in cash or deposits. So, Lisa, I'd love to hear your thoughts. Like, how did investment culture develop in the US? I simply imagine that didn't happen overnight. Did you see this investment mindset coming as this desire to kind of like to take care of your oneself, loved ones, rather than relying on the state? Was it more about what Lisa was saying before about structural shifts? So what lessons, if there are any, could other countries have and learn from the US experience?
Yes, and thank you, and good morning, good afternoon, everyone. And I would just maybe share a couple of thoughts. I think the U.S. Can be used as a case study, right? We did a lot of things right. We also made mistakes, and I think the benefit of watching other countries' events can really help in that regard. And you're absolutely right. This isn't something that happened overnight. As Lisa Bleier referenced, this sort of evolution of building a culture of investors here in the United States really started in the 70s, decades ago. And it really became sort of a perfect storm of regulation and lawmaking that really promoted individual responsibility for retirement. You had an evolution in our financial services industry. It's probably not a shock that Charles Schwab's company was started in 1974 as all of these changes within our retirement scheme here in the United States were changing. Really one of the first retail investing firms that served to make investing accessible to every single person at a much lower cost. So eliminated sort of the need to only the wealthy could invest in securities. And you had an industry that really jumped on board with regulatory and legislative changes in our country. And as Lisa shared, we had really a change in the workforce. You know, my father got out of college and went to work at IBM and worked there for his entire life. And so that idea of a defined benefit plan or a pension that was provided to you by a single company because you were going to stay there your entire career made a lot of sense. You know, as we saw in the 70s, 80s, and certainly today, you know, the average person changes jobs 9 or 10 times in their career, and they want that portability. They want that ability to take what they've accumulated in the way of retirement savings with them. So it took a while, but it really was a combination of the industry building the right infrastructure and capabilities, individuals starting to educate themselves and take advantage of what was available so that they could feel empowered and confident in their investing. And we had really a government and media that supported this notion of independence and responsibility. We also had a very vibrant capital market system. And, you know, the United States has always been known for its entrepreneurial spirit and that ability to take an idea, have venture capitalists fund that, and ultimately have individuals like you and me be able to participate in that idea and that growth, really started to see wealth creation and people's habits and lives change dramatically.
Thank you, Lisa. That sounds really interesting. Maybe something I'm thinking of, both having heard you and the other Lisa talk about this. I think one of the underlying shifts that we have as well is kind of like, I think you talked about this investment culture that also was very much connected to this shift also from defined benefits to defined contributions. We have a similar trend here in Europe. Of course, that means investment risk shifting from the pension providers to investors. However, also investors seeing a higher return. Since you said all this started in the 70s, so like maybe I could ask, so what was the experience like? How were you able to encourage investors that, you know, maybe weren't investing before or weren't kind of like familiar with taking risk to kind of do those 401k plans, open investment retirement accounts? Was there also something in terms of, you know, you talked about, you know, like regulation and stuff that kind of like made it more interesting then for employees to switch to DC plans?
Yeah. So I maybe I can start, and Lisa, if you wanna chime in. You know, I think it was a little slow at first, and if you look back at some of the portfolio allocations in the 70s in particular, and even in the beginning of the 80s, there was a lot of money market sort of cash holdings in 401k plans, and it really took, I think, a mandate around an employer's responsibility to ensure sufficient education around things like the importance of diversification into multiple asset classes, the impact of investing and the compounding that occurs during you know, a 40-year period, and probably most importantly, helping people understand that volatility doesn't necessarily, if you're a long-term investor, mean you're going to, over time, ultimately lose money. Just the opposite. In fact, you'll probably see the greatest amount of appreciation by taking a little bit more risk. And that education was really important. And even today, on an annual basis, most employers, at least annually, but if not more ongoing, really spend a fair amount of time ensuring that their employees are taking time away from their jobs, being educated on all forms of investing. And they really look at it as a key benefit in attracting and retaining talent. Because without that education, without that understanding of market volatility, what the ups and downs look like, but over a 30 or 40-year period, the equity markets is where your greatest amount of value appreciation is going to occur. It's really tough to get people away from feeling like putting money in a savings account, earning 2% for the rest of their life, but it won't go down. You won't lose money. They don't understand the impact of inflation and other things without that education. So it really was a concerted effort, with the combination of the government, the industry, and the employer really pushing to ensure that that we created individual investors. And it did take decades, to be fair. It did not happen overnight. What helped certainly was an incredible market with marquee names like Amazon, Facebook/Meta, Google, etc., and investors being able to participate in that. And we've really seen a shift here in the United States from a mindset that started in the 70s when we moved off the defined benefit plans to defined contribution. We do a 401k participant survey every year at Charles Schwab, and our 2025 survey really showed kind of this shift. In fact, 85% of people surveyed said that a 401k plan was a must-have in making a decision to go to an employer. So people really understand that as an opportunity for them, like we look at our healthcare benefits, really our bonus and base salary benefits, that 401k component, having that, how much the employer matches, really matters to our people here in the United States. And that survey also showed that people consider the 401k component of their financial plans. 45% of that is their retirement income. So almost the majority of an individual's sort of retirement plan comes from the savings and investing that they do through their employer's 401k plan.
And I'll just add, there's a variety of places where we've removed the friction from the system. And I know we're going to get to a bunch of these later, but the growth of target date funds, because people didn't know how to plan a nice mix, right? If people were investing and making their own choices, target date funds, actually you had somebody professional who was putting together that mix. Things like, I know we'll talk later, also auto enrollment. It's kind of like each time we find some sort of point of friction, we've tried to address it. We still have remaining points of friction, but we're working them through them one at a time.
Look,
Yeah, and Lisa, maybe I can just add one other piece, because I think it's important from an employer's perspective. I've been in this industry for a very long time, not since the 70s, but close. And I've really seen a pretty big evolution. And I would say even 10 or 15 years ago, an employer would, because of some of the fiduciary requirements that they have with respect to 401k plans, would educate but really back away. And today I would say in the last 10 years we've really seen a dramatic shift from an employer's perspective, where that financial wellness is almost as important or as important as an employee's sort of physical wellness and the work that they do. And when they're working with firms like all of ours here, they really look to what additional help you're providing their employees on that financial wellness journey. Certainly the retirement component is an important one, but to Lisa's point, they are doing everything they can to ensure that employee is getting to where they need to be, whether that's increasing the matches that they provide on what the employee contributes to the plan, putting things in place like automatic increases, the percentage of your compensation that you put away to retirement. Many employers actually just have an automatic escalation, so that as you get a raise or other things happen in your career journey, you don't even have to think about increasing that contribution. It sort of defaults into that. You can certainly back away if you can, but to Lisa's point, really any type of friction that would stop somebody from engaging in this activity is been removed systemically over time, as we've learned where those points of friction are.
No, that's really interesting. Maybe reflecting on two of the things that both of you have been saying before. I mean, one of them that the majority of the retirement savings stems now from the 401k, and also looking at your father who worked his whole life at IBM. I agree. I think those days are over. So does the system adapt also to now this kind of like much more, I think like more different employers, but also I think we do have, gig economy with irregular working agreements, contracts. So, I mean, does the current system cover that? Is there groups that are not covered? Is this being looked at? So maybe I can throw this out here as well and ask, maybe Lisa, would you have an answer for that?
Yeah, so it's a good question because we are always looking to find new ways to address various challenges out there. And you are right, the gig economy, it's referred to as the gig economy, those who are not working in traditional business, we've had to look at other ways to engage them. And we do have a variety of products that would work for individuals. We do have individual retirement accounts, the IRA system itself. Um, but those have lower contribution limits than a 401k. But we've also tried to create plans that would encourage small businesses. Yes, I'll throw out an acronym, SEPs and Simples. Those are for special ones for small businesses. But then the newest things we've created, and I saw somebody question this and asked about this in the chat, are pooled employer plans, and a similar type of plan called a multiple employer plan, which allows small businesses to pool their employee base together to participate in a bigger plan and get the benefits of an economy of scale. So while these are fairly new, and so there is not yet significant adoption, I do anticipate increased adoption there. But for all of these products, right, often the investment vehicle are target date funds that kind of can look at across somebody's full career.
And Lisa, I would also add, I think all these things are highly portable, and I think that's also important. It is very easy for an individual like you or me, as you move from traditional employer to traditional employer or traditional employer to gig economy work, that money that's been accumulated and has grown is highly portable. So not only is there a robust 401k system infrastructure, but there is a robust system to continue to contain those retirement assets in a segregated way, but it's highly portable to move from employer to employer or employer to self-directed, like an individual retirement account that a firm like Schwab would hold. So again, making that money solely of the individual and extremely portable is important as well.
I think it's very interesting. I mean, both things, and maybe we can discuss them later on, but it's also things that we're discussing here in Europe as well. So one of them, of course, issue of portability, much more difficult given that we are here talking about individual member states with their own, in particular, pension laws, but also something that Lisa had mentioned about economies of scale. That's also something then in kind of like the question with portability or limited portability, how you can reach those kind of like economies of scale. I know that we're kind of like, it's a fascinating discussion, but again, looking, I think, at the time, maybe what we could do is kind of like shift a bit away from kind of like this investment culture and coverage, and maybe dive in a bit deeper into like the pension product landscape in the US. I think you've been, both of you have been referencing target date funds as well. So maybe I'm looking here at Andy and Sudipto to maybe help me along in the next few questions I have. Maybe also as a background for you guys. So use of life cycling strategies has always been like a really hotly debated issue in the EU for the last number of years. Good news is that it's really, I think, gaining traction. We have the EU now wanting to make, we call this the Pan-European Pension Product, PEP, so throwing in another acronym in our discussion as even the default option. Andy, I tried to do some quick research and I saw that approximately 2/3 of all the 401k inflows go to target date funds, which I think is just another way of talking about life cycle strategies. So this seems to be a clear success. Has this always been like this? Has there been some kind of like major event that led to this? So please, if you could explain, that would be great.
Yeah, thank you for the question, Andreas, and good morning, good afternoon, everyone. And Andreas, if you'll let me, I'm actually just going to take the liberty of just defining target date as well. And I know it's a term that in some countries outside the US, it does mean something a little bit different. And so I'll just level set here. So, I mean, I think of it as an investment vehicle that really aims to make saving and investing for retirement kind of straightforward, cost effective, and also providing an underlying investment portfolio that actually evolves with the investor. So it's always appropriate for the investor. And so how it works is that an investor, a retirement plan member, will allocate all of their contributions actually throughout their entire investing life into a single vehicle where that vehicle is named with the year when the investor expects to retire. So the 2040 vehicle, or vintage as it's often called, is for investors who expect to retire in the year 2040. And then that vintage invests in a portfolio that automatically kind of retunes the investment strategy as the investor gets older and their objectives change. So what that means is for younger investors where their main objective is to really kind of grow their wealth, grow their capital, that's generally going to lead to higher allocations to equities and other risk-seeking assets. And then for older investors who are getting close to retirement and their objective is going to be more to do with preserving the wealth that they've actually earned, then it's going to be higher allocations to fixed income bonds and other lower risk assets. And that change in investment strategy is known colloquially as the glide path inside a retirement target date. And the portfolios are professionally managed, usually by asset management organizations. They're generally quite large vehicles, so that means they can benefit from economies of scale, which means they can be quite cheap and quite cost effective. And there's a lot of debate around target date, but I think there's also general agreement that it's actually been a hugely successful way of helping actually many millions of Americans who are members of retirement plans get invested in a well-managed, cost-effective, and appropriate portfolio. But if I now get your question, which is, has it always been this way? And the answer to that is no. And I'm going to reference some of the things that actually both Lisas referred to, but I'm going to put my own framework around it. And so through the 1980s and the 1990s, 401k, I think, had been really quite successful at getting workers to save and invest in some form for their retirement through employer-based retirement plans. But there were also flaws, and I think one flaw was that not every employee inside a company that had a plan would actually join the plan, and then in addition, even when somebody joined the plan, they never really engaged with the plan, and that's a problem given that most 401k plans are actually structured with member choice. So if members don't engage, then it means they're not making a choice. And so the plan sponsor has to figure out, basically they've got to make a decision on where to invest those contributions for members who didn't actually make a choice. And what happened was that plan sponsors generally defaulted those contributions to cash. So why cash? Well, the US is a fairly litigious environment, and essentially, the plan sponsors were worried that if they put the contributions into a riskier portfolio and it didn't work out, then there was real scope for litigation. And but if contributions are going into cash, then it's a real problem because it leads to lower returns. So that sets the scene, and both of these problems were addressed somewhat in a pivotal piece of legislation that was passed in 2006. It was called the Pensions Protection Act, and critically, this legislation created something called a qualified default investment alternative, or QDIA. And that's basically an investment option that can be used to invest retirement contributions for members who do not make their own investment decisions. But critically also, the QDIA provides a kind of safe harbor protection to employers. So in other words, they can't be sued. It protects them from liability for investment losses. And target dates were basically awarded QDIA status. And so that sets the scene for a majority of assets going into target date. But what the Pensions Protection Act also did was encourage employers to adopt auto-enrollment. So basically automatically enrolling members into a plan. It didn't actually mandate it, but it did remove legal impediments, and it provided safe harbor again for employers that put auto-enrollment in place, so members couldn't kind of basically sue the employer for automatically putting them in a scheme. And in fact, what has happened since then, Andreas, is that there's been another piece of legislation called Secure 2.0. It was passed in 2022, and actually that's mandated auto enrollment for all new plans since 2023. So bit of a long story there, but really identifying the Pensions Protection Act as being just this great moment which really enabled auto enrollment and also qualified default investment alternatives.
Look, thank you very much. Maybe what I'd be doing is really jump on, you mentioned auto-enrollment twice and what a big game changer this was. Maybe next question to you, Sudipto. So maybe coming again back to our EU background. So there is a growing number of EU member states that have auto-enrollment. Some of them are looking into this. This is still at bequest of member states themselves. Ireland this year has just joined doing this for the second pillar. We also, as EFAMA, are always saying that auto-enrollment itself, I think, is the true game changer. So maybe following up on what Andy has said. So how's the situation now in the US? Would you agree with him that this was like really a game changer and it's a great success?
100%. First of all, good morning, good afternoon, good evening, everyone. Yeah, agree 100%. I mean, the Pension Protection Act, that was kind of an inflection point, in terms of the DC system, the development of the DC system. So how the I'll go back. So Andy mentioned a little bit about, there were some legal challenges, and I'll mention, some in particular, and how the Pension Protection Act, helped with the adoption of auto enrollment. So there were state wage garnishment laws, so which basically prohibited employers from deducting pay from the paycheck without an explicit consent of the employee. So that was one of the hesitations for employers, to deduct from their paychecks and put it into a pension plan. So the PPA, the Pension Protection Act, that addressed that the federal law would sort of supersede those state laws. So that gave protection to employers. And the other piece that again Andy mentioned about safe harbors. So for 401k plans, what employers have to do, it's pretty onerous. We call it discrimination tests. So which are basically just pretty extensive reporting on the plan that they have to do to show that the 401k plans are not benefiting their highly compensated employees. And again, what the PPA, the Pension Protection Act, did that if these 401k plans just followed some simple design that they auto enroll participants, they have at a minimum contribution, add employer match. If they do all those things, then they don't have to do some of those discrimination testing reporting. Again, so that was a big incentive for employers to adopt auto enrollment. So because of all these things, I think after that, auto enrollment just took off, and along with that, the target date really. So there has been plenty of studies, academic studies, industry reports that show how dramatic the impact of auto enrollment has been. So I can quote you just one number from from our record keeping business. So Rowe Price, we record keep for about 2.4 million participants, 401k participants. So I was just looking up at some of our numbers. So in 2006, just about 18% of plans in our book of business, they had an auto enrollment, and in 2024, that number was 68%. So you can see from 18% to 68%. So that's the dramatic shift that we're talking about in terms of adoption of auto enrollment. And then if that also means that it's still a voluntary system, and not every plan has auto enrollment, right? So there are still plans where it's voluntary for the participant to enroll. And again, in our book of business, we still see there's a huge gap in terms of participation for plans that has auto enrollment, and plans that where it's voluntary for the participant to join. So, for example, in 2024, in our book of business, plans that did not have auto enrollment, overall participation rate was 41%, and plans that did have auto enrollment, it was 85%. So again, 41%, 85%. So you can see the gap. So overall, auto enrollment, it has, really auto enrollment, combined with QDIs, it has changed the DC landscape completely.
Okay, thank you very much. Maybe I wasn't paying attention enough on this, but I know that because Andy was talking about it and you were also talking about this QDIA, Qualified Default Investment Alternatives, right? Sorry, I'm just familiar with the European slang here. So maybe Andy, just maybe take a step back and talking about this again, just that we get the importance of all of this, because both of you were referencing it.
Yeah, absolutely, and yeah, it's interesting. QDIA is one of those acronyms that's almost become part of normal language in the financial world and with retirement plans in the US. But so yeah, let's just unwrap this and get this very clear. So a really critical piece of legislation. So remember, prior to the Pensions Protection Act, the issue was members not engaging with their scheme, consequently not making an investment decision, retirement plan sponsors therefore having to make the decision and generally defaulting the money to cash so that they wouldn't get sued for potential investment losses in a riskier default investment. And so the Pensions Protection Act solves for that with this concept of qualified default investment alternative, but basically QDIA. And the principle here is that it basically creates a special category of investments where a retirement plan sponsor can make it an automatic default for any member that does not make their own investment decision. And they can do that because they have safe harbor and they won't get sued for potential investment losses on assets that go down in value. And critically, target date is identified as one of that small number of special assets that qualifies as qualified default investment alternative. So I realize I'm being slightly ponderous. There's a bit of detail, but it is such an important moment. And that sets the scene for actually a majority of contributions going into target date. So myself and Sudipto, we're kind of identifying this as a critical moment, but I think the reasonable question would be, okay, so has it worked? And there's a few things that we can put out there. So the first one would be that today around about 95% of retirement plans use target date as their qualified default investment alternative. There is lots of debate about target dates, about whether or not it's necessarily a great solution. But when you drill into what those debates are, actually those debates are generally about more nuanced issues, not is target date good or bad, but it's more, is it okay to have one glide path for every investor, or the cost of it, so the cost of passive versus active version of target date. But I think the broad outcome here is actually quite straightforward, which is it's led to more members being invested in sensible portfolios, generally with more equities, which has led to meaningfully higher returns. It's actually led to better investment disciplines, such as rebalancing, because the asset manager does it for the member, and so it stops the member from making behavioral mistakes with their portfolio. It's generally led to a better diversification, so it's a better kind of risk-adjusted return experience for the member. And I think a lot of that, I'm talking to the US experience, but I think it's tremendously relevant for Europe, because remember that many DC plans in Europe are invested very heavily in fixed income. And so that will inevitably need to lower returns than the US style target date, which has higher allocation to equities. But so lots of detail there, but just remember that the critical moment was Pensions Protection Act and enabling qualified default investment alternatives, and target date is one of those QDIAs. Sudipto, I said a bunch there, but I'm wondering if you have any additional color you'd add to that.
Yeah, of course. I mean, so you pointed out to the right question, which is, has it worked? And you pointed out, yes. So target dates are now the dominant QDIAs. I can also point out a couple of sort of data points that show how it has changed like the or impacted participants or members of these plans. So I think Lisa was talking about this at the beginning so broadly that how the investment culture and everything has changed, and a lot of it happened through the retirement plans, and particularly the wide adoption of target dates. So I can cite some data from the Federal Reserve. So it has a survey called, Survey of Consumer Finances. So the Federal Reserve is our central bank, very, very well known. And so from that survey, if we go back, way back, like 1989, it's about 29% of middle income families, had held any stock, right? And if you then fast forward to 2022, that number is 60%. And I'm talking about middle income people, so not just higher income folks that who might have a different investment pattern. So from 29% to 60%, and during the same period, holding of individual stocks increased only slightly. So most of this change in stock holding for middle income families that has been driven basically by retirement accounts. So that's one, and the other piece is the real sort of impact, I would say, or a tangible impact is also the asset allocation. That how Andy described how the glide path works. That you start when someone is young, it's equity heavy, and then it becomes more conservative as they age. So again, we have some data which shows how this has completely, sort of changed the asset allocation for participants who are invested in 401k plans. So for example, we have data from a think tank in DC, Employee Benefit Research Institute, very, very well known. I actually worked there in my past career. So their data shows that, I think in 2007, participants who are in their 20s, only about 50% or so were really highly invested in equities. So 80% or more of their portfolio was in equities. So just 50% of 20-year-olds. So that number in, I think, 2022, it has now shot up to 91%. So 91% of participants in their 20s, they are now 80% or more in equities. So, and that's what you would see. And that's, I mean, I cannot, overstate the benefit of that, because they have like their entire career now to reap that equity premium, what we call that the high returns from equities, and also what we call that the compounding, right? So by the time they will reach retirement age, their projected retirement savings will be much higher. And that's and the key here is that they really didn't do anything. So it was all done sort of by default, by design, through policy, things like auto enrollment, QDIAs, and target date.
I mean, it's really interesting what both of you are saying. A lot of things, and I think in the discussions as well, yes, we're using different acronyms for this in Europe as well, but really this idea, like what a default should be in what you should invest in what kind of like stages of your life, this idea about target dates. It's completely the same here, or kind of like saying maybe you see the US, but here it's still the 70s in terms of that we suffer from a lot of pension funds really being predominantly invested into bonds. But we are not talking here about the people 60 or 70 and close to retirement, but also all those people that are just joining. So it's very interesting thing to hear that. Again, being quite conscious that the clock is ticking. Both I think you and Andy talked about kind of like glide path. I really liked the word vintage. So maybe let's kind of like think of what happens once you reach your vintage and you kind of uncork the bottle. how does that actually work? Because kind of like, sorry, just trying to talk here about maybe how decumulation and stuff work. Because here we talk about, like lump sum payments versus annuities. I think there are slightly different words and experiences in the US context. So maybe that would be worth kind of looking at how does that look like then at the time when you're actually trying to draw down on some of your investments. I think, Sudipto, if you want to start maybe on that.
Sure, I'll do a quick description of what's happening right now, and Andy, feel free to jump in. So the target date system, as it has evolved, the focus has really been on accumulation. That the 401k system, it kind of really started to grow in the 80s and 90s, and target date really started to wide adoption started late 2000s, right? So only now we are seeing participants or members who are arriving at retirement with significant or all of their assets in the DC system, maybe in a target date. So right now there is a lot of focus on how to generate income, right, from those the savings that they have accumulated. And this is where I would say, there's a lot of innovation is happening. A lot of, new product designs are coming into the market. Some of them are, sort of insurance based, where it's a combination of investment and insurance. Some of them are purely sort of investment solutions. So I'll give maybe a couple of examples here. So one recent sort of trend has been adoption of what we call embedded annuities within a target date. So the general design is that when someone reaches a particular age, say, they are invested, they are in a target date, and when they are at a certain age, say 55 or so, a certain portion of their allocation goes towards, an annuity, right? And when they reach retirement, say 65, they will have the option, whether they want to annuitize that or not. So that's sort of one where the target dates are including an insurance-based solution into the design. And then, there are other sort of more pure insurance solutions where we combine sort of a managed payout, with a target date at the stage of retirement. So managed payout means that basically it's an investment solution, but that it will kick out, a monthly stream of income. Again, it depends on the underlying investment, so the income might fluctuate a little bit from one month to the other. But the idea is still that you preserve the liquidity because it's an investment solution, but then it kicks out some income every month. So that payment sort of starts when someone retires. So these are different new concept and new product ideas that are coming into the market. I would say this is really early days for any of these things, and how the adoption of these and how they work out, it has to play out. We have to see. But there is a lot of discussion and energy now in this space that because target dates are the sort of the predominant savings vehicle, how they can be used to address the income phase, and that's a lot of work is happening.
That's very interesting. Andy, do you have anything to add to that?
Yeah, I mean, just one point, actually. I'll just make a kind of slightly broader comment. Well, actually, one broader comment would be 100% with Sudipto, that in some ways, what you do during retirement, so decumulation, it's the next big challenge for our industry, and there hasn't really been the creation of the common standard yet. So I think there will be some really intriguing innovation. But what I'd also highlight is that for a number of years, retirement plans were actually quite happy to see members take the assets out of target date at retirement, essentially because providing services for people in decumulation is complex, it's expensive, it's litigious, but that is now changing, and it's changing because plans are really keen to retain assets, because that means that they can then maintain scale, and it means they can deliver lower costs per member. And so lots of innovation, as Sudipto said, and increasingly actually positioning target date as some form of decumulation vehicle. and there's some clever innovation, but there's also some really basic features such as recommended withdrawal rates from target date or auto payout features inside a scheme's administration. But it is the next big trend. So positioning target date as some form of decumulation solution.
That's very interesting. Also, what you're saying again about even in decumulation phase, or for those asset managers, that retaining scale or assets is important for them. Maybe because I promised the listeners that we'd be trying to take the questions that are coming in. There was one of them as well, which I find quite interesting. Doesn't maybe necessarily fit in the flow of what we've been discussing. Maybe going back a step to kind of like more the wider setup of in the US and the regulatory environment. I think it kind of goes back to this kind of like question. Okay, is a lot of the pensions money then actually invested in the US? I assume that is the case. But would you then say this was because there was regulation around that, or was it simply because the investment markets, as you were saying, 70s and something were thriving, so therefore having more opportunity? And then the other question, because we have that in our discussions in Europe as well about autonomy and all this. Also, of course, we quickly talked about passive products and where those products end up with. So, what would then also be the lessons as such? What could Europe do in terms of trying to emulate the US's success? So, I don't know if any of you would want to take this higher level question.
I mean, maybe I can start. I would suggest, the bias in a 401k portfolio towards the U.S. equity markets over more global equity markets isn't a law per se. It is just a function of sort of the model portfolios that have been built over time here in the United States. And while almost every risk tolerant style of investing, whether it's moderate or aggressive or very aggressive, will have some component of global assets included in it. The reality is the U.S. capital markets is just so dominant, both from its breadth and its transparency, liquidity, accessibility, et cetera, that it ends up being a larger percentage of the holding in there. And I guess maybe my comment to that would be, we've spent a lot of time talking about the individual, the participant, the member, whatever we want to call it. I think we've forgotten one additional component that is so powerful when you think about what the transformation in the U.S. retirement environment meant really to our economic growth. And the economy overall. And I think if you look at the trajectory of our U.S. equity markets, the NYSE, NASDAQ, et cetera, if you look at just the growth of the public markets and the ability for entrepreneurs, people with great ideas who start small companies to gain capital and ultimately bring them public in a way to continue to expand and grow, creating more jobs and more economic growth, that wonderful cycle that we see here in the U.S., it really took investors, whether they were investing through a target date fund that were being managed by an asset manager who was buying these equities on the open market, or individually, it really took that individual investing mindset to really blossom and explode, frankly, our public markets here in the U.S. And I think that's maybe a missed component of this when each individual country might be looking at how to grow their economy, how to create more jobs, how to generate more income so people spend more money, et cetera. A lot of that has to do with creating a robust capital market system to enable that.
That's very interesting. Sorry. Maybe one of the points as well, because you were saying, like about this explosive growth of the public market. Unfortunately, I think European markets are very far away from that. So I think that's why there has been another component in all of this, that because we do not have the same number of IPOs and therefore companies that you can invest in, we are looking, I think, more and more into the kind of like this issue of private markets. Of course, understanding that private market definitions in the EU would be quite or are quite different than they are in the US. But maybe is there something as well, maybe to the rounding kind of like, has there been a discussion about this kind of like also then private markets and how more long-term investments would actually fit into those also retirement solution products?
Shall I make a comment on that, Andreas? So,
Please.
I mean, and this is a super live discussion at the moment. It's definitely a political focus, and I think in the US, not yet legislated. However, most independent experts, or experts at least, would agree that private markets can be additive to a target date, well, in fact, any portfolio, but certainly to a target date portfolio. And a lot of plan sponsors are broadly familiar with the benefits of private markets, actually from their defined benefit plans. But having said that, in target date, I think there are some notable hurdles to widespread adoption of private markets, and actually some of these do once again relate in some ways to litigation risk. I mean, one is higher fees. Target date is a very fee sensitive segment of the market, and private markets generally have a higher fee point. The need for clearer regulatory safe harbor. So if it doesn't work out, it's important that the retirement plan sponsor is protected. Actually, also, it's fairly kind of other practical points. So target date, although it's a long-term investment vehicle, it tends to be daily liquidity, and so having a semi-liquid or even an illiquid product fitting into that daily liquidity structure, that can be that could be a struggle as well. And so I think this is an area where we're going to see action and development potentially sooner than we might think. But I also can see how getting private markets into target date will be a fairly slow move. Andreas, I'm really sorry to hog the mic, but I would just kind of make a couple of other points if I may. I was so fascinated by the discussion there around the fact that so much, basically, it's this fusion between having very vibrant local capital markets and also having strong retirement saving. And I can see exactly why European regulators will have to think carefully about whether or not there's a case for actually trying to direct some retirement savings assets into local markets. We've seen in some markets that that's been addressed actually through tax measures. I also think that there's some very interesting things going on in Asia right now, actually, where there's things underway in Japan, in Korea, actually in China as well, even in Thailand, which are basically the government mandating companies to actually do everything they can to raise their valuations. So in other words, improving corporate governance. And I think all of these things fit together into a very important legislative mesh. So I think, and this is something I rather hope that European regulators will grapple with in the coming years.
Oh, that's very interesting. Again, looking at the time, I think unfortunate news is that we have 2 minutes left. Maybe what I could do is, because questions have been coming all from me, I'd like to know this and that. From I think our very whirlwind discussion about all those different topics, was there something that I forgot that you would say also from a US perspective, a trend that sounds really interesting and that should at least be mentioned in this whole pensions debate as well?
Well, I'll just make a mention. It was noted in the chat, the reference to the new Trump accounts, only because those are going to be a potential big deal, not just when they're created, which will be this summer, but looking forward long term. The idea was to introduce young children, babies, to the capital markets, get them in early so that they get the benefit of compounding interest. And we expect that there will be a big financial literacy push related to that, which is a great chance to educate both children and their families as part of that.
That's fascinating because, of course, we're mentioning financial literacy as well, but of course, it's, I think, two sides of the same coin when you talk about investment culture. That is not possible if you don't have the tools with that, but of course, you have to be able to try first and also make your own experiences, which is learning by doing as well. I'm very sorry to say, but I think we've unfortunately run out of time. But I think I'd like to sincerely thank my fantastic speakers, Lisa Bleier, Lisa Hunt, Sudipto, and Andy. Please, thank you very much for, I think, those really interesting discussions. Also, of course, appreciate all the listeners who've joined us today. If you'd like to share this session with your colleagues, if you thought it was so great that you want to listen to it again, we will be sending out a recording of or a link of the recording very soon to all of you. And with that, thank you very much to all of you. Wishing you a great rest of the day or morning, wherever you are. Thank you very much and goodbye.